The 2020 Recession's Impact on Institutional Private Real Estate. This educational video is courtesy of BlueRock, a leading national alternative asset management firm with more than $8 billion in managed real estate assets. The following is educational in nature and is not intended as investment advice. Additionally, this video contains forward-looking statements, performance information provided by third parties, and has various limitations more fully addressed at its conclusion. The COVID-19 pandemic has had an enormous social, cultural, and economic impact. Its far-ranging impacts push the U.S. economy into recession and could transform many real estate sectors long into the future. Institutional private real estate will evolve from these transformations, and history suggests that this recession will impact private institutional real estate very differently from previous financial recessions. We believe the lasting effects of this transformation will be a significant property sector performance divergence, creating winners and losers. Throughout the 42-year history of the NCREIF Property Index, the flagship index of institutional private real estate, there have only been two drawdown periods, or value declines, from 1991 through 1992, and from 2008 through 2009. These drawdown periods occurred in two major recessions, but distinctly, these were two financially driven recessions. The 1991 through 92 recession was driven by the savings and loan crisis, and the 2008 to 2009 recession was a result of the Great Financial Crisis. What was unique about those two recessions compared to 2020? Their financial-driven nature puts real estate at the epicenter of the two prior recessions. When real estate was not a key component of a recession, such as those in the 1980s or 2001, institutional private real estate posted positive returns. By contrast, stocks and public REITs have both experienced substantial drawdowns nearly every year. The recession of 2020 thus far has not been financially driven, and therefore, we believe negative impacts to institutional private real estate will be muted compared to financial-driven recessions. Next, let's explore several factors that make a compelling case for institutional private real estate in 2020. First, pricing discipline in the most recent economic expansion was supported by modest growth of commercial mortgage debt. In the two previous expansions, commercial mortgage debt soared, fueling high real estate pricing that ultimately corrected. The 1983 to 1990 and the 2002 to 2007 growth cycles led to the only two periods in which the institutional private real estate index value declined over a 42-year period. The current expansion has produced very modest debt levels and thus does not indicate any significant correction. These lower mortgage debt levels can also be expressed as average loan-to-value ratios of U.S. commercial real estate over time. As the chart illustrates, loan-to-value ratios have been generally declining since 2007, suggesting a more conservative investing approach in the sector, leaving it less vulnerable to corrections. Our analysis therefore concludes that mortgage debt levels indicate the market is not overheated. But what about valuations? An important evaluation metric of the relative value of institutional private real estate over time is a concept known as the cap rate spread. This is simply the cap rate, or the unleveraged yield of real estate, versus the risk-free rate of the 10-year U.S. Treasury bond yield. Spreads near or above the long-term average implies that real estate pricing is not overheated, as cap rates are not low relative to the 10-year U.S. Treasury yield. In fact, current cap rate spreads to the U.S. Treasury yield are above long-term averages, a strong positive indicator. Historically, during periods where cap rate spreads were above the long-term average, such as during 2003 and 2010, the following 3 to 5 year returns for institutional private real estate were also above its long-term average. Next, mortgage debt and cap rate spreads indicate a much healthier real estate market in 2020, compared to the lead-up conditions experienced during the Great Financial Crisis. However, despite these healthier overall conditions, various real estate property sectors will likely fare differently in post-COVID-19 world. For the most part, we believe trends that were already evident have accelerated. Highlighted here are the real estate sectors that we believe will be most and least sensitive to the 2020 recession, including those that may experience a positive impact. The industrial sector, driven by e-commerce, should be one of the main sector beneficiaries, while sectors such as hotels, retail, and senior housing being most negatively impacted. The specific sector outlook is shaped by demographic and technological forces that ultimately drive sector performance. We present our outlook of most favorable sectors in focus. The industrial sector has been transformed by the rapid growth of e-commerce, and we expect that trend to continue. The apartment sector, driven by new demand from household formation among millennials and an overall supply shortage, should benefit in the long term. We believe real estate debt has an attractive risk-reward trade-off and will offer opportunities in distressed and non-distressed property sectors. Specialty sectors such as medical office, student housing, senior housing, life science properties, self-storage, and data centers offer a promising view. Many of the specialty subsectors are demographically and technologically driven and therefore warrant strategic allocations. We believe the specialty subsectors most likely to outperform are life science and medical office, data centers, and manufactured housing. Despite short-term differences in sector performance and our specific near-term outlook, institutional private equity real estate is a unique asset class traditionally sought by pensions and endowments, boasting a 42-plus year track record, historical 6.9% plus annual income returns, and a history of generating higher risk-adjusted returns and lower correlation and volatility to the broader markets. For more information on institutional private real estate investing, please visit our website at bluerock.com. Unless otherwise indicated, the information provided herein is as of June 2020. Blue Rock does not undertake to update this video, even in the event that circumstances change in the future. Further, certain information contained herein is derived from market and industry data and forecasts that were obtained from third-party sources, industry publications, and publicly available information. We believe that this third-party data is accurate and that estimates and assumptions are reasonable, but there can be no assurance as to the accuracy or completeness of this data, and we have not independently verified any of the data from third-party sources referred to herein.